What's going on, everybody? Welcome back to the Wealth Webinar, where we are going to literally talk about one thing and one thing only: money. We're going to talk about how you can take back control of your money. We're going to talk about the infinite banking concept, but today we're going to break it down to the myths, the IBC myths. What is the infinite banking concept? Oh, it's a scam. Oh, it's this stupid thing. It's just life insurance. I've heard all of them. But we're also going to then parlay, after we go through the myths, into the number one change that will change everything in your financial life. We're going to go into that, and we got a whole bunch of other stuff. But I just thought this was a great topic to cover because, I hear it all the time. Our team hears it all the time. Oh, that's a scam. When you talk to your financial advisor and you mention this thing, the infinite banking concept, what do they usually say to you? Oh, don't do that. That's not a good idea. That's a bad thing to do. I hear all this, but I mean, Craig and I have had some choice conversations with financial advisors, and here's the full conclusion. Believe me or don't believe me, it doesn't matter. I can prove it. I can prove it over and over and over. Financial advisors want you to believe they can do everything and that they understand everything with money. And I get it. I used to be one. 16 years. I had that ego of thinking I know everything. I know all this stuff. And I'm going to tell you a story in a second. But when we get these advisors on, they say, oh, I know what the infinite banking concept. And we say, okay, tell us what it is. Oh, it's a whole life policy, blah, blah, blah. Oh, so the infinite banking concept is just a product. And basically that's what they know. And some of them are like, oh, it's like this be your own bank thing, but it doesn't work. And we hear it all the time. Some of them even say, oh, it's an IUL. Or others will just come in and be like, oh, don't do that whole life. That's not a good idea. The infinite banking doesn't work. But hey, buy this IUL. This IUL is great. We were dealing with one of our really good clients, and he had a family office. Now, I will say family offices usually understand this really well and understand how to use this and understand the pros of this. But this family office, man, oh man, all they seemed to want to do was just sell an IUL. And we had to go back and forth. Craig, I put him, oh, I felt bad, man. Kind of be like, I take Craig and I throw him out in this field, but I know there's lions and tigers in the field, but I'm like, Craig, you got this, no problem. And that was kind of what it was like, but he did well, and the client saw through it all. But, would it be helpful if you had a financial advisor that understood the infinite banking concept, understood the problems it can solve for you, but gave you holistic advice on everything you're doing without saying, hey, yeah, I can help you manage your money, but you got to move it over to us. And wouldn't it be cool if your financial advisor managed your cash? Like literally, looked at the bank accounts you have and said, hey, listen, I can help you get a better interest rate. I'll search and find you the best interest rate in the market for your money. They're all FDIC insured, or build a CD ladder for you and manage that CD ladder, or manage your treasury bills and treasury bonds in conjunction with everything else. See, all these things are what I knew as a financial advisor were things that we didn't like to do. Financial advisors typically don't want to manage your cash. Why? Well, they can't get paid on it. That's quite frank, the reason why. Number two, they don't usually want to do CDs because that's what the banks do. We don't do that. We manage stocks, bonds, mutual funds. And most financial advisors will give you very, very little, if any, financial advice until you move your money to them. Okay? So now they've got custody of your money in some account. It could be Fidelity, Vanguard, Schwab, but then they're managing it for a fee. And that's how they get paid. And listen, nothing wrong with that. But sometimes I got to believe that certain people, all they want to do is get advice. Hey, I got this 401k and I don't know what to do with it. And I don't know how to manage the funds. I don't even know what any of these mean. Could you look at that? Oh, and by the way, I got this old IRA and Roth IRA I set up. And now over here, I got this 529 I set up with my buddy, and then he's no longer in the business. And I got a bunch of cash in these different banks. I'm trying to get the best interest rate. No, over here, I got these life insurance policies with this company called BYOB that we're doing this banking thing. Wouldn't it be super cool if somebody could just advise you on all of that? Well, Stefan and Brandon run PMC Wealth, and I'm going to be bringing them on this show so you guys can talk to them, bounce questions off them, but they run PMC Wealth, which is a brand new take on the financial advisory world. So I just want to give a shout out to them, but it's done, it's open, we are operating, meeting with clients. And if any of you are interested in meeting with them, we're happy to set you up with a call. But let's get into the myths. I know some folks, they watch the infinite banking concept. Maybe you've seen our 90-minute presentation on my YouTube or chrisnaugle.com. Maybe you've seen us speak, myself, Brent, Hannah, one of the speakers out there. But you kind of got this idea of this concept, this system, this process that literally allows you to become your own bank. And when you were hearing about it, there were some things that just sounded too good to be true. And I'll be the first to admit it. When I first heard about this, it wasn't because I was seeking it out. It wasn't because I saw a social media ad or watched a YouTube video. I was out snowboarding in Utah. And while I was in Utah, I had this guy, Mike, who was a private lender and a real estate investor that I met at one of the investor summits. And I had a deal that I wanted to get funding for. So while I was in Utah, I had texted Mike and I had said, hey, Mike, I'm going to be in Utah. You think we can get together, catch up? And I got a deal I'd like to show you. Sure, let's meet at Cheesecake Factory. Now, a lot of you have heard this story, so I'm going to not do all the bells and whistles of it, but I just want to preface a couple things. When we sat down at that Cheesecake Factory, I remember it's downtown Salt Lake City, right at the mall. And we're sitting there ordering our food. And I don't know, just while we were ordering, small talk, I'm like, so Mike, how do you lend all this money? It's just like super casual. Now, let me preface, I was a financial advisor at that time. My wife and I were flipping a lot of houses. So we were really doing a lot of real estate. And, I was doing the advisory thing. So I was deep into the advisory. I worked for a small boutique RIA at that point. I only basically served the 16 years with two different investment firms. There was only two that I was with. I kind of am one of those people. I don't really jump ships a lot. I just kind of stay where I'm at. I build up. So the second firm I was at was kind of a bougie boutique, right? Like an RIA, and we managed like elite money. We managed institutional money. We had our own funds that we managed. We thought we were the shit, or at least the owner did. But nonetheless, I'm here with Mike. And I said that to him, and he very quickly responds back, I lend from my own private bank. That was his answer. I lend from my own private bank. All I heard was private bank. Whoa, Mike has way more money than I thought. So then I just started saying, just started asking about it, inquiring. And I said, so Mike, what do you mean? Do you have a bank? After we're done eating, should we just go over to the bank? I kind of wanted to see the bank, right? I'm a tangible kind of touchy. I like tangible things. So I wanted to go see the bank. And Mike was like, oh no, I don't actually have a physical bank. I operate just like a bank. And then I just started asking questions and he gave answers. Now, play along with me, folks. And I just want to, and actually, if it's okay, I'm just going to, I always like to at least use the board to make it feel like I get my use out of this. So the first thing he tells me when he's talking about his private bank is that he says the word guaranteed, okay, which is, how many of you like the word guaranteed? Is that a good, sexy word for all of you? You like that word? I love guaranteed. But he said guaranteed, and then he said the word interest. So here's how I operated, guaranteed interest. You all like that word, right? So when you think about that, and if we had to put guaranteed interest in a box, what would we be thinking about? We'd be thinking bank. I was thinking CD. I was also thinking annuities, like fixed annuities. So I'm just putting all these things that I thought this private bank could be. So number two, he says, I get guaranteed interest and I also get dividends. So when you think dividends, what do you think about? What's the first thing that comes to your mind if we were to put this in a box? Probably the same as me, right? Okay, it's a blue chip stock that pays dividends. That's what I was thinking. Or a private company that pays dividends. I mean, there's a lot of ways you can get paid a dividend, but the first most common thing is stocks. So he's going fast at this. I'm slowing time down. He's just rattling these things off. And he says the interest and dividends grow tax-free. So as an advisor, and I'm sure all of you, as you're seeing and hearing these things, what you're doing is you are trying to formulate an idea in your head of what these things could be. Guaranteed interest, banks, CDs, annuities, dividends, stocks, maybe private dividends, grows tax-free. This is where I was kind of stumped. I had two things. I'm like, okay, it's either a Roth IRA or a muni bond. But muni bonds, well, they don't pay guaranteed interest. I guess maybe he's calling it guaranteed interest or dividends. But in my mind, I'm thinking I'm smarter than Mike. And Mike maybe just doesn't know what he's saying. He maybe thinks that the dividends are the yield he gets from those muni bonds. So he gives me all three of these. So I kind of got this thing pretty well figured out. And then he goes on and he says a couple other things. I'm just going to do these small. He said, protected against judgments and liens. I think he just said it's a protected asset, but judgments and liens. So meaning if he gets sued in one of his real estate deals, they can't take this money. So, when he was saying that, all I could think, boxing that out, I think trust. Okay. And then he said 5, he said, and when I die, it gives my family a payout, a legacy. Now, that was the first thing he said that made me think, okay, legacy means maybe life insurance, but life insurance definitely doesn't pay, maybe dividends. I knew what whole life was, but all these things together, I just wasn't putting together life insurance as the thing. Then he tells me how it works, because I think I asked him. He tells me what it is, like, well, how does it work, Mike? What does it do? And he gives me all these things. And then I had asked him what it was. Now I'm going to pause that because you already all know it's a specially designed whole life insurance policy. But before I was able to ask him what this thing was, what he told me is he said, when you need money, you ask me for a loan. I go in and I take a loan from my private bank, just like you would take a loan from some other bank. He said, I take a loan from my private bank and I give that money to you, which from me to you is a loan. So I'm using loaned money to loan you money. And I was a bit confused at this point, but here's where he really got me. And this is where I said, bullshit. He said, and when I give you money, I don't give you my own money. So my money still earns guaranteed interest, dividends, in a tax-free environment, protected from judgments and liens, providing a legacy for my family. That sounds pretty freaking outlandish, does it not? Okay, Mike. Indulge me, Mr. Wise Private Banker. Indulge me on how that's even freaking possible. Like, you put money into this stupid whole life thing, because I did. I'll be first and foremost. I was a financial advisor, man. I managed assets. I managed stocks, bonds, mutual funds, muni portfolios, you name it. We did it. And you're talking about whole life insurance here, and I'm like, okay. But he got me thinking about it as to how are you earning interest and dividends in a tax-free environment when you just gave me the money? But you said a loan. Like, why are you taking a loan? And then he explained the whole thing to me, and it just kind of clicked. I just got it. It just wasn't hard to understand, right? How many of you kind of, I broke that all up, but how many of you kind of get that, right? It's not difficult to understand, but let me just draw it, and then I'm going to get into the myths, because up to that point, I'm like, bullshit. I'm saying this is a myth. That's too good to be true. There's nothing that can do that. You can't earn uninterrupted compounding interest and make money twice on the same dollar. But it's pretty simple, actually. And I never, I was an advisor at this point, let's just say up to 14 years, 13, 14 years, if I go back in time. I'd never heard of any of this stuff. I just want to preface that. And I worked for a financial firm that, well, you all know, New York Life. So I worked for a branch of New York Life called Eagle Strategies. It was their registered investment advisor. Their broker dealer was called Nile Life Securities, and the parent company was New York Life. So clearly, I knew whole life insurance. I had sold lots of whole life insurance, but I didn't know whole life insurance could be designed and engineered. Matter of fact, what I knew of whole life is if I put money into a whole life, here's what I knew. Okay, I knew that I would not have any cash value for at least 3 years. This is what I knew as an advisor based on the whole life I had said. No matter what I do, what I thought, I pay premium payments. Okay, this is what I thought. I pay a premium payment to New York Life for the whole life. I get a death benefit. Yeah, after many years, I have cash value. Because listen, as a financial advisor, I did sell whole life, and I sold it as what they call the SLRP strategy. Supplemental Life Insurance Retirement Planning. I did a lot of this. And you know what I used for that? Whole life insurance. You know which kind? 10-pay. And do you know what I did? Nothing. I just sold a 10-pay whole life policy. Like, what else is there? You put your premiums in. There's no real cash value for 3 years. And then after 10 years, the thing starts looking pretty good. That isn't very sexy. But now let me reframe that. Let's say it was the same policy from the same insurance company, except for now you had access to your money immediately in the first 30 days. Is that better? Yes? Because that's better to me. And that's what Mike said to me. But that isn't what I understood about whole life. I understood whole life to not have any cash value in that. When Mike said, nope, Every time I put money in, I have access within 30 days, which was 100% foreign to me. So my oh shit meters went up, just like I'm sure a lot of you, as you've heard about this thing, you've heard about that. So let's dive in. And Craig, I'm going to give you the sharing capability. Could you just pop up the slides? I think it'll be easier if people just have something to look at, because we're going to go through and we're going to dismantle some of the biggest myths about the infinite banking concept. And then what we're also going to do is we're going to show you how to literally do your own banking system. And then not just that, we're going to show you how it just involves changing one thing. So to become your own banker, it involves one change, and that's where your money, your savings goes first, and then one step, which is the process. Susan said, isn't that what our Social Security benefits basically are? We're never going to get what we paid in and can't touch it for most of our life. How true is that, right? We never really think about that, do we? Like sometime way back, I don't remember when Social Security came into fruition, but there was this idea that they were going to take money from our paychecks. They were going to put it into this government-run fund, and that fund was going to be used to supplement our retirement, give us some extra money to help us kind of get on with life after. It was never meant to be a sole retirement, okay? It was never, ever designed to be that. But think about it, like every month, or sorry, week or bi-weekly, however often you get paid, on there is a line item, a subtraction from your paycheck for Social Security. That money goes to the government, and it sits there until 62, anytime after 62, we'll say. But it really doesn't get good until 66 or 66 and a half, right? 67, let's round up. That's about when you can take it. So if you're 30 years old, you're putting money away for 40 years, hypothetically, 30 to 40 years, and you're never able to touch that money, like Susan said. Okay. And you're never going to get out of it what you put into it. But yeah, we all do that. And we don't even think anything of that. Well, here's the good news. Like, isn't that what our Social Security benefits basically are? Yes, but there's not a single whole life, not even a base whole life, that would work like Social Security, because there's not one whole life where you would put more in premiums in than you take out. Period. Never seen one. I've never seen a whole life. I've seen some of them take a lot longer, but most of the ones we design have a cumulative break even anywhere between, the earliest would be 3 years. That would be really sexy, but usually between like 5, 6, 7 years, cumulative break even. So what that means is you put money into the policies that we design, especially designed and engineered ones, and you have access to that money immediately in the first 30 days. I almost said 30 years. Immediately in the first 30 days. A percentage of that, 60 to 90%, give or take, okay? So then you can use that money, which is the process we're going to go over, the system called the infinite banking concept. And then after 5, 6, 7 years, you've gotten all your money back that you put into the policy, but you never lost liquidity of a percentage of that, okay? But you got all that money back. And then every year after that year, it's gravy. Everything you make in dividends and in interest and in compounding is money on top of what you put in, but it's all gains for the rest of your life. It can never do anything other than go up. Guaranteed. I'm sorry. That's pretty freaking sexy. I am used to stock portfolios. I'm used to real estate deals where sometimes they're good, sometimes they're bad, sometimes you lose it all, sometimes you lose a little, sometimes you make a bunch. But it's just a wild roller coaster. With this thing, it's just like, if you were to start today with your policy and you were to look down into the future, it's just a line that goes up, and that line kind of bell curves, or hockey sticks as they call it, and gets faster and faster. That's just compounding interest. But let's get into these, because I think these are really important. The top 5 IBC misconceptions, okay? We hear these. That's why we came up with the top 5. Number 1, too good to be true. How do you earn uninterrupted compounding interest on all of your money? IBC, what is this IBC thing? It sounds too good to be true. Is it a loophole in the tax system? Because they said it's tax-free. How can it grow tax-free? These are all the things. But here's the beauty. This isn't new. It's been around for hundreds of years. It's one of the oldest, most predictable financial tools you could ever use. Dividend paying whole life. Like, we didn't create this stuff. Matter of fact, Somebody was asking earlier about IULs and whole life. There's drastic differences, but I've got lots of other videos that show that. So I can hit on it at the end if you're still with us, but I don't want to waste time on that because that's not a misconception. All we know is IULs are pretty much garbage. And you know what? The Bush family's doing a good job of rubbing its face in the mud, telling you, hey, you quack like a duck, you look like a duck, but you're not even a duck. You didn't do anything a duck does. The lawsuits. But too good to be true. Craig, what would you say about that? Like, what did you think about it? Did you think it was too good to be true?
Well, I did think it was too good to be true. And part of the challenge, and you asked a question about financial advisors earlier. How many times have you heard the comment that, oh, my financial advisor told me you can't dump in money? My financial advisor told me that you won't get any money out of this system for 3 to 5 years. There's no way it works the way these guys are talking about it.
Yeah.
So I don't know what they're telling you, but it's just too good to be true. I think that those are some of the things I've heard over and over, and I'm assuming that's what everyone else hears from their financial advisors as well.
How about
But
you, Stephen?
With too good, I mean, so it's a little bit more than that, I guess, if I want to get into it. So too good to be true. I mean, so the first year that I learned about infinite banking, Chris, it was one of those things where it didn't sound too good to be true, but I felt like it was one of those kind of gimmicks, if that makes sense. One of
Okay.
those things where, and that does lead to where you watch the presentation and you're like, there's no way that's possible. Like, and it leads to that it's too good to be true kind of mentality. And I felt that personally. And then, once I started my first policy and I really embraced the power of infinite banking and what it can actually do for me in my own personal life and realized, hey, everything in that presentation, there is no gimmick at all. Like that's the way it is. And I was like, holy cow, this is amazing. At that point, about a year later is when I decided to get licensed myself, Chris, and actually start helping on the mentor side of things. And so that first year when I started working as a mentor with the BYOB Money School, I talked to probably 250 clients a month. I was on the phones constantly talking to people all across the country. And keep in mind, you guys, this was during COVID. So this was at a time when like everybody was home, everybody was looking at stuff. So it was very easy to have these conversations. I was on the phone all day, every day. It was what I was doing. So I talked to a lot of people, and it gave me a really good insight into the mindset. And I will say, during that time when I was talking to that many people every single day, it really made me realize, and I heard the same thing over and over again. I did hear that. This sounds like it's too good to be true. There's no way this is real. I kept hearing that over and over again. The other thing I heard all the time that's not on this list, not really a misconception, but people would say, I wish I would have learned about this sooner. Or maybe this would be kind of a misconception, maybe a sixth misconception would be, I wish I could have learned this sooner because now I'm too old to do infinite banking. I mean, do we hear that all the time as well?
Yeah,
People
all
in their
the time.
50s, their 60s. Oh, I can't do this. Let me start a policy on my children, on my grandchildren. Well, that's like a sixth misconception. I'll add to that because that's what I heard over and over and over again. And so I realized that it wasn't only me that thought that when I first saw that. It's a very common thing. Why? Because it truly is such a powerful strategy when done the right way with the right support and with the right team supporting you behind the scenes. And that's really what we have today. And it's a beautiful thing.
I love it. So that was the first thing. So I love that.
hey,
Yeah, go
Chris,
ahead.
just one quick thing. And I'm sure there's some people out there that like to see the numbers. And if so, before we go on to number two, this whole too good to be true, should we show what a traditional whole life policy looks like? And should we show what a specially designed whole life policy looks like?
Yeah.
What do you think?
And,
Oh
and
yeah.
on top of that, I'd love to show an example of using it in real estate, just a real simple, quick example as well.
Well, all right, let's do it.
So part of it comes back to it, Chris, as you were explaining when you were a financial advisor, you knew certain things, but when you started hearing about this banking system, you're very confused over all these things like what could this animal be? And so I'm sure you had in your mind, well, whole life, there's no cash value for the first few years, right?
Oh yeah, I mean, maybe 1 to 3% IRR is about what I would see.
Yeah. So what I want to do for our audience, because look, at the end of the day, if you walk down the street, let's say you're listening to all this infinite banking stuff, you learn its whole life, and you make it your mission, you're going to walk down to, say, your State Farm office. You walk in, open up the door, they got the little bells on the door for Christmas, jingle, jingle. Like, hey, how can we help you? Hey, I want to get one of those whole life policies. First off, they're not going to know what this infinite banking concept process is. And if they say that they do, then the first question I'd say is, well, how are you using it, right? We always want to find out if you know what it is, how are you using it? But sadly, the way most of these get designed, and this is why a lot of the financial entertainers out there, like the Dave Ramseys, they don't like whole life. So let's just look at a traditionally designed whole life policy. I have one up on the screen. Can you see that okay, Chris?
Yep.
Let's just say we're putting in a little over $10,000 of premium every year. Okay, so you walk into your State Farm office. I want to put $10,000 a year into this policy. What they're going to do is say, oh, let's take that $10,000 and let's just put it all into the death benefit component. So you're going to see over here that $10,000 is buying almost $846,000 of death benefit by the end of year one. So there's a lot of death benefit for that $10,000. Now here's the downside. If we're building a banking system, just like what Chris was talking about earlier, where we want to get money in there, we want to use it for financing major purchases, we want to use it for debt, we want to use it for opportunities. How valuable is it when you have no cash value available after putting $10,000 in? Because that's what the reality is of traditional whole life. $0 of cash value. Year two, $0 of cash value. Now, by year three, you've put in over $30,000 of cumulative premium because we had 3 years of putting in the 10, and now you have $5,433 of cash value to use. You might look at that and go, well, that's not very good. And so in order to build a banking system, is that the way we want our banking system to work, where we're putting in 30,000 and having 5,433? So, like Shauna says in the comments, it feels more like those other investment vehicles, which this is not an investment, but it sounds like those other tools where 401ks or whatever they are, we're putting money in and we don't have the access. All right, so I want you just to think about that number, 10,000 going in, $846,000 of death benefit and zero cash value. Now let's flip the script and let's say, what if we had the ability to design the policy in a way that was more beneficial for cash value, maybe less death benefit? So what that would look like is something like this. Same amount of money going in, right? 10,155. And now at the end of year one, we have 8,410 versus zero. So if you're trying to build a banking system, wouldn't it be better to put in 10,000 and have access to 8,410 or zero in the traditional whole life? Now here's the thing that needs to be considered, is that if you're putting in the 10,000 and we're getting 8,400 of cash, look at the death benefit. In the previous design, it was 860 some thousand, and now it's 164. So by the way we're designing these policies, you're going to have more cash value. You're going to have less death benefit. So that's just fundamentally how the designs are going to work. Now, Chris, I think you had mentioned some of the break-even points. I'm going to go back to the traditionally designed whole life. So over here we have the cash value, the total cash value. And if we just kind of scroll down and we want to find out, when do we break even cumulatively? Well, by year 17, you've put in $172,000 and you have 174,000 of cash value. So we're breaking even cumulatively by year 17. That's not unheard of for a traditionally designed whole life policy. It takes 15, 17, 20 years to break even. The other thing that we see is this thing called cash on cash return, which we're measuring on a year by year basis, not a cumulative. So when we put in $10,000, we want to know how much cash value do we have. Well, by year 8, when we put in that $10,000, we finally have $10,000 of growth. So this is where we are now positive cash on cash, meaning put $1 in, I got $1 of growth. That's happening at year 8 with this policy. So let's go take a look at, if you're working with our team and we're building policies for you, cumulative break even is about year 6 here, where we put in 60,000 of premium and we have about 62,000 in cash value. So we've already broken even cumulatively by year 6 and by year 4. And Chris had mentioned, sometimes we see this in year 2, sometimes in year 3. It's all highly dependent upon the design and the person that we're insuring. But look what happens in year 4 when we put in $10,000. We grew $10,699 that year because of the previous years of compounding. So we're now cash on cash positive, and that will be positive for the rest of our lives going forward. One more thing, Chris, and then I'm going to hand the baton back over so we can talk about the second thing. But see this cash value growth and how it's happening. Is that going to be impacted with most of the companies we work with if I take a $20,000 loan at the end of year 3? So if I'm taking $20,000 out to go do something with it, is this growth number going to be different? The
No.
answer is no. So that's one of the benefits of using this strategy is as I'm putting these funds into the premium side, I'm building cash value. I'm building this uninterrupted compounding machine that is not going to be impacted because of the companies we work with. They're not going to interrupt our compounding when we're leveraging this 20,000 or we're leveraging 38,000 or whatever it's going to be. So, Chris, Stephen, any questions? Otherwise, I'm going to bounce out of here and we'll go back to the second myth and talk.
No,
I
but
think
I am going to share my screen though. So if you stop screen for just a second, and then
Okay.
Pram was just asking, she bought the vault. So this is what you guys are looking at right now is the BYOB vault, and
Correct.
all of you can join this. It's a subscription based membership, and you can start using it to look at debt payoffs. If you have policies, you can put them in there and do all the stuff. But Craig, if somebody wants to learn more how to use the vault, you guys, I know you're doing that nightly show right now, but what are some different ways she can get some support and learn how to use it?
Yeah, I would say go out to the byobvault.com and I'll put that link in. But as a matter of fact, let me just share this out real quick so that people can see. So if you go to byobvault.com, and Chris, I think just put that in the comments.
I got you.
What'll happen is you can go to the homepage without even subscribing. You can go to the homepage and you can see an intro to the vault video. You can also play around with a demo. We have if you're trying to get out of debt, there's a kind of a demo page here where you can go play with some of our sample debts. You can add some of your own debts, clear these debts out, add some of your own debts. But this does not save. If you subscribe, then you can go ahead and play with that some more. But anyway, this will go through and it's got some infinite banking policies in it you can play with. If you want to see what velocity banking would do with your debts, you can update your numbers. But that's where I would start. And then if you do want to trial the vault, you can go in there and do a trial. And then every other Thursday, I'm doing a session where I get in and do a deep dive with all the subscribers, do trainings. So all of that stuff's available. All right, Stephen, you want
Yeah,
to share
very cool.
some?
And I just wanted to give one example real fast. So this is just showing how one of these policies operates and just kind of showing what it would look like if we did not use the policy and just put our money into somebody else's bank versus putting money into one of these policies. So as Craig just showed, this is what's called an illustration. It just shows all the numbers. So the cool thing about infinite banking and what we do also is you're going to see one of these illustrations and you'll have a good idea of how your money is projected to grow and how you can use that money over the rest of your really lifetime right up front before you ever sign on a dotted line, before you ever send the insurance company, your first premiums or anything. You're going to see all of this. You're going to kind of know exactly what your future looks like before you even start on it. Okay. And our team will do that when you schedule a call. I put a link just a second ago to schedule a call with our BYOB money mentors, but that's what they're going to do. They're going to talk to you about, hey, how old are you? What does this look like? Why are you using this policy? Things like that. And then we're going to talk to you about what is the right amount of money to put into this. So this is an example of one of my real life clients I helped a few years ago. She was a real estate investor out on the West Coast of the United States, and she had just closed the deal. So she had $150,000 that she wanted to put into this deal. So if you look at the contract premium, you can see 150,000 going in year one. and she had a lump sum because she had just closed a real estate deal. And then she told me she was comfortable putting up to $50,000 a year into the policy starting in year 2. Now, notice I said up to. She's not required to put in 50,000, but that's the most she can put. If she needs to put in less, she can. These are also very flexible, even once they're in force, on how much you can put into them. But this is how it was designed, with 150 going in the first year and then 50,000 a year going in after that, as you can see on here. Okay. Now, her idea was to use this policy to continue doing active real estate deals until she could get on the other side of the fence and the ultimate of real estate investment, which is really becoming a bank and becoming a private money lender. Okay. So I'm just giving an example of that, what this would look like in year 8 of this policy. So 8 years from when she started this, which has been 3 years from before. So in 5 years from now, what happens in year 8 of this policy? Well, we can see the increase in net cash value. Now, the increase in net cash value, the cash value is the amount of money each year you can borrow from the policy to use. And like Craig said, when you borrow the money, even when you take all that cash value out of it, it's still going to grow and compound this same way because those loans are not recognized. And we'll get into that on the phone call, but just know that's how it works. All right. So $66,000, her bank, her policy grows in year 8 of owning this thing. Now, to get that 66,000 in growth, she puts in $48,000 in premium in year 8. Okay. So she put in 48,000 and had $66,000 of growth. Now, if we do the math on that, that's $18,000 of growth, or a 37% cash on cash return. Because remember, as soon as she puts $48,000 into that policy that year, she immediately can borrow back out up to $66,000. So that's a 37% growth on our money just by putting it into the policy without ever doing anything with it. Now, let me ask you this question, Craig. When we start these policies, are we starting these just to put the money in and let the money sit? Or are we starting these to put the money in and immediately pull the money out to use for other things? Option 2,
Yes.
right?
Yeah, and typically it's going to be, if you're in debt, we're using it for debt. If you're trying to finance a major purchase, we're using it for that purpose, or we're using it for opportunity funds. Like what you're showing.
Exactly. And that's what I'm showing with opportunity here. So she puts the money in, she gets the 37% growth that year just for putting it in. But again, the power of this is being able to pull it out to use it. So that same year, what she decides to do is pull the money out and put it into a private real estate lending opportunity. Okay. And let's just use 12% growth on her money through that private money lending loan. That's pretty common that we see these days. All right. So if we do the math here, her money at 48 years old, her money is going to grow by 12% through doing a private money loan that's backed, collateralized by real estate, protected. Her money's going to grow in her privatized bank by 37%, the money that she puts in that year. Again, that's almost guaranteed. This is including dividends, which are not guaranteed, but it's guaranteed growth in the policy. Now, we do pay the insurance company when we pull the money out to use it. So let's say that's 5% annual interest. It's gonna be a little less if we're paying it back throughout the year, but just for simple math, that's 5%. So if I do the math here, my money grew in year 8 of this policy by 44%. Now, here's the question you have to ask yourself. If she would have never started this policy 8 years earlier, what would have happened? Well, she would have been putting her money into a savings account or a business checking account. She would be using that money for deals. Whenever that money comes out of the checking account or out of the savings account, there's no growth anymore. It's gone. It's in the deal. It's an or thing. With this policy, it's an and asset, okay? So here's the difference. If she would have never done this policy, she would have grown her money that year by 12%. That's it. She takes it out. She does the private lending deal. She grows it by 12%. But because she started this policy 8 years prior, not only is she getting that 12% that year, but she's also getting that 37% minus 5 for a total of 44% on her money. So you have to ask yourself one thing. We didn't, which way are you better off? We didn't do anything different except where our money goes first. And your money has to go somewhere. So you have to ask yourself, would you rather put your money into somebody else's bank or put your money into your own banking system where you have this uninterrupted compounding tax-free growth now for the rest of your lives? And really that in itself is what being your own banker is all about. So I hope that example helped a couple people.
I love it because, it just shows like it's not that you got to all understand something. The policy is not going to make you wealthy. It's just not. I mean, it's the process. Because that's what the infinite banking concept is. It's not about a product. That's a misconception, but it's not a product. And it's not an investment. I'm getting ahead of myself, but it's just a system that you use in your life. What he showed is one piece of that system that allows you to use money make money on it twice to do real estate, right? So the infinite banking concept by Nelson's definition is it allows you to take back the banking functions in your life. It's a system that allows you to take back the banking functions in your life because we outsource our banking functions. That's what we've been taught to do. We make deposits in traditional banks. When we need money, we borrow from traditional banks. We use them. They use our money to then lend our money back to us at a higher rate, making a spread. This system just reverses that. It flips that. It puts you in control, making you the banker. Why do we use a whole life policy? Well, it's quite simple. Stephen just explained it. Craig did a little bit. It's just more efficient. You can put money in the whole life. You can then use that money or a percentage of that money, but not lose the compounding on the original money. They call that opportunity risk. They call that lost opportunity. Okay. So if you, for example, if you had, I don't know, there was somebody on here who had big numbers. Let's use $1 million. If you had $1 million and you put that $1 million into a high yielding savings account because you wanted to make a little extra money or CDs or something, and that money's making 4%, we'll call it 5%. Like you got a really good bank that's giving you 5% on CDs. And you're thrilled. But then all of a sudden you get this slam dunk opportunity to invest in a company with full guarantees and collaterals and everything else, whatever, I'm making this up, and they're going to pay you 10%. And you're going to have a big exit at the end. So you're like, okay, I'm going to take my $1 million out of the bank and I'm going to put it into this investment because it pays me 10. I mean, that makes that's a smart decision by most accounts, right? As long as you know what and like and understand what you're investing in. But let's just talk about what happened. If you had a bank account paying you 5%, that you had $1 million in that you were happy with, but then you took $1 million out to put in this other investment that's going to pay you 10%. Most people would be like, yeah, duh, I'm making 5% more. But what if you could make money on both? What if you could still make the 5% on the $1 million and then make the 10% too? That's what this allows you to do. And some of you are like, well, wait a second, Chris, there's an interest rate on that life insurance loan. Absolutely there is. But you're making more than what you're paying over time. That's it. You're making the spread. How does a bank make money? Let's just pretend all banks pay you interest on your deposit accounts, okay? You got a savings account in a bank. The bank pays you interest, right? When the bank lends you money, they charge you more than what they're paying in interest. They make a spread. Here, the insurance company pays you a dividend crediting rate, and over time, as a blend, that dividend crediting rate is a higher interest rate than what they charge you in loan interest. Plus, your money is compounding up, okay, uninterrupted compounding interest, while the loan that you took from the insurance company is simple interest. And then if you use the infinite banking concept and you recycle and recapture the money, that loan is being paid down automatically through the process, reducing the APR. Craig, I believe you have software that shows that, so hopefully we get some time to show that. But I kind of jumped around a little bit. Now, can we pull that slide back up with number 2, misconception? This is a good one. And this one is very much the case. It's the case whether you're talking to advisors, whether you're going online. It's only for wealthy people. Now, I will say this doesn't work for everybody because if somebody isn't saving money, this can't work. You know, you got to capitalize your banking system. You got to capitalize the policy. It doesn't just grow out of thin air because you sat down, meditated about it, and be like, grow, grow. No, you gotta plant the seed, folks. You got to then water the seed, which is premium deposits. But it is not just for the wealthy, and I can prove that. My very first policy I ever started, it was just a normal whole life. I've done a bunch of YouTube videos showing you where it's at, but it's like 17 or 18 years old now. Okay, but when I started, it was nothing sexy. That policy was started with roughly $240, my very first one. And then I had another one that was $389, I think, give or take a buck or two. So those are small amounts, okay? That's how I got started. I think I'm doing okay, pretty good today. You know, I'm buying all these cars and getting all the money back for them. I'm doing real estate deals. I'm doing all sorts of stuff, and it's all being done from my private banking system. Matter of fact, when someone suggests I do something other than that, I'm like, are you stupid? I don't mean that, but like I kind of do. I'm so far down the rabbit hole of being my own bank that I can't even peek my head out the top anymore and be like, you know, is there someone that just said there's something better? Wait, they said I should take a loan from the bank because the bank's only 3% and the insurance company charges me 5%. Misconception. Like You don't understand math, because if you heard that, some of you are like, well, yeah, if the bank's only charging 3, but the life insurance company's charging you 5 on the loan, why would you borrow from the policy when you can get a bank loan at 3? Well, we can show you the mathematics on that, and we will, because that is a misconception. You can make more paying 5 when you're earning 3. Okay? You can. And we can show that. And we do that in the 90-minute video. Can you make more earning 4 when you're paying 6? Yes. Because you understand math and how math works. And it always works that way. It's not some fancy dancy algorithmic like calculation. It's simple math. But it is not too good for, or it is not just for the wealthy. It's for all of us, as long as you're saving money. And one of the things here that I think people need to understand is the difference between someone who's rich and someone who's wealthy is wealthy folks figured out how not to give money back. This system allows you to not give money back, does it not? It gives you a guaranteed. You saw the numbers that Stephen and Craig showed. They only go one direction, right? And that's up. It is physically impossible for the policy not to make money every year, because it has guaranteed interest. And the dividends, yes, I know they're not guaranteed, but they've paid them every year that these insurance companies have been in existence. Every year, never missed one. Not during the Great Depression or the Great Recession, never missed one. So these are the things. I mean, wealthy people scale the system. That's what they do. They build a system, they follow a system, and they scale that system. That's what all of you are doing. I'm not reading all the chats coming in, but I guarantee you a bunch of you who had, 9,000 or 9 trillion N's or nines on here saying you've been here this many times, you're scaling your system. Most of you don't have just one policy. You probably have multiple policies because you're building a banking system. And I can tell you that you are doing exactly the right thing, because if you drive around in your town and you drive past the Bank of America, there's a chance you're going to drive past another bank on that same street, and then another bank on that street, and then another bank on that street. I mean, here, Key Bank is a big bank here. I can go down the road, I will pass a Key Bank, and within not even a mile, there's another Key Bank on the other side of the street. It's like, why do we need so many branch offices of one bank? Well, when you start to ask the question, and when you start to think about your banking system, you're never going to just have one branch office, one policy. Over time, you're going to scale your system up. You're going to scale your banking system up because you're going to create more money in your family. You're going to take back money you're giving away to other people's banks, i.e. debt. And then you're going to have all this extra money coming in, and you're going to realize very quickly that the policy you built to get started, although it could have been a really small $240 a month policy like mine, you're going to realize you don't have the capacity to put more money in. Because when we build these policies, we build them to your specification, not ours. We don't tell you how much your premium deposits are. You tell us how much you're saving and how much you want to save. Okay? We're not selling you a life insurance policy like most people that would be like, well, this $100,000 death benefit whole life policy is going to cost you $429.62. No. We ask you, how much would you like to save per month, per quarter, per year? And you tell us, well, Chris, I'd like to save $1,000 a month. Wonderful. We design the policy around that savings, and we design it for the most efficient, high early cash value. And then we use the Vault software to prove that it solves your problem efficiently, mathematically. I don't know if that made sense, efficiently and mathematically, but mathematically efficient, I think, would be the way to say that. Everything we do is based on mathematics, and the wealthy people do the same thing. But again, I just want you to understand, it's a misconception to think that this is only available to the wealthy. The next one, I already said, it's not an investment. I hate it when people are like, oh, that's a terrible place to invest money. No shit. It's not an investment, you dumbass. Sorry. Had to get that out of the way. We didn't get enough arguing this morning on WTF, so I still had a little in me. But I mean, like, think about it. What by definition is an investment? Can someone pull it up? Use AI, Craig, Stephen, ask AI, give the definition of an investment, and someone please read that. Because thinking of this as an investment it's a very dangerous mindset to get yourself into.
Are you doing it, Craig?
Yeah, I can read it. An investment is buying an asset like stocks, bonds, real estate, or commodities with the expectation that it will generate income or increase in value over time. helping you grow wealth for future goals like retirement or a home, but it always involves the risk of losing money.
There we go. I mean, we could have saved all that and just went to the bottom line. It
Yep.
always, an investment always involves the risk of losing money. Not saying you're going to lose money, but there is a risk of losing money. In a whole life policy, can any of you tell me what is the risk? Is the risk losing money? How? The risk is maybe you don't get issued. The risk is maybe you didn't get the rating you wanted. The risk is maybe you talk to somebody down the line after you start your policy and they say, oh, you should have bought an IUL. What do you got with that stupid whole life policy? And you don't listen to us and you move to a IUL. That's risky business right there. But I mean, I'm just saying, like, you can't call this an investment because it is not an investment because it involves no risk of your investment. Okay. So it's not, it's a savings plan. It's a whole life insurance policy. That's it. It's just a forced savings plan. All you're doing is redirecting, changing one thing, and that's where your savings goes. You were putting the savings in a savings account. Great. Now you're putting it in your whole life policy, which is your private banking system. Oh, you were saving money in your 401k, but you were putting in above and beyond the match. Great. Let's change where that excess goes to be saved. See what I'm saying? Not hard. You just change where it goes, but that's not what makes you wealthy. It's what happens next. You have a machine, a banking system. There's not a bank in the world that takes deposits in, puts all the money in the vault, and leaves it sit there. Tell me a bank in the world that does that. There isn't one because they would be out of business. A bank must take the deposits and make that money go to work for them at a higher velocity or a higher interest rate than what they're paying on that money. Simple concept. We're not going to get into fractional banking, but that's what we're teaching you. Be the bank. Okay? All a bank does is takes deposits in, just like your private bank does. You're taking your own deposits because it's your private bank. You're not a public bank. You're not taking deposits from other people. You're taking your deposits from your family because it's your private bank. And then once you got your private money sitting there, we call that capitalization, we need to make that money go to work because that's what makes you wealthy. So we always talk about paying off debt. We talk about paying off your cars or buying cars because you get all the money back for every car you buy, drive, and own. We talk about investing in real estate, lending on real estate. Why? Well, it's because something we know, like, and understand. And because real estate doesn't have wheels to get up and drive away. Real estate has, over the course of time, always appreciated over long periods of time. And real estate can be the collateral for our loans. And I want to be like the bank. And what do banks love to lend money on? Real estate. So you can see, how do we come to the conclusion with PMC and everything else we do? Because we copy what a bank does. I'm not that smart. But banks, they got some smart people. All I do is mimic and copy what they do. And you know what? That's what Nelson did. Nelson one day sat down and he's just like, this is bullshit. I can't figure out why I can't get ahead. And then he talks about being on his knees and praying to wee hours of the night. And then it hit him in the face. Like, I think he uses a baseball bat to the head. And he says, he figured it out. It just came to him. I got these whole life policies. I can use these whole life policies to pay off my debt and finance the things that I need. Like, he was in forestry, finance the equipment I need for my forestry company. He then just had that realization that he was going to be the bank, and he created the infinite banking concepts. Anyway, can't say enough about that, but please don't let that dangerous mindset creep in. Don't let anyone tell you that the specially designed whole life, is an investment, because it is just not by definition. You can't call it. Craig, anything you want to say on that, or did I just kill that one?
Well, I mean, you nailed it, but here's what came to my mind as you were talking. And, I meet with a lot of folks talking about strategies, and it was probably 6 months ago, I met with this gal and she said, my husband and I were sitting down the other day thinking about all the money we've made throughout our whole lives. And she goes, what's sad? She goes, I don't have much of it left. She goes, I hardly kept any of it. And, people get stuck on this investment mindset of what we're doing. And really, if she would have just captured some of that lost opportunity, and that's really what we're talking about, is they still bought cars, they went on vacations, they invested, they did all these things. But if they would have just simply taken some of that money, ran it in through this process into a specially designed whole life policy, and then bought their cars, paid it back, bought their cars, paid it back, what would it look like for them, when they're now in their 60s and 70s? It would have been a completely different picture. So that's what came to my mind as you were talking, is just reliving that conversation with that gal, because it's, she came up with some number and I don't remember what it was. She said, this is how much we've made through our lives and we have almost none of it.
That's the, Craig, I've literally never thought about that. But like what you just said, like I just had this new realization, like
Mhm.
just imagine that every dollar you've ever put into your bank, okay? Just imagine if that money was still in your bank, but you
Mhm.
still bought all the things that you did with that money. And that money that was still in the bank continued to earn even a modest return of 4% every year for your whole life. I'm 48. So let's say I started saving at a young age, but let's just say at a bank at 16. Okay. So 16 to 48 years old. I can't even imagine. I can't even imagine how much money I've made and put in banks and then spent. I can't even fathom that. But imagine if I put it in an account and then I spent that money, but I still continued earning on that money. You know what's cool? We could model that. We could literally show the math on that. And I think we will, but let me get through the rest of these. How crazy is that? Did that sink in for everybody? I'd never, ever given that thought. All of you have run substantial, monumental amounts of money through banks because you've made money your whole life. And you've been taught to do what? Deposit it in the bank. And then what'd you do from there? Well, you spend it on this, that, and the other thing. Even if you just said, okay, what did you spend on houses, cars, boats, anything that you bought an asset with, like large purchases. Even if you just did the math on that, how much money has it been? Millions, millions of dollars. At bare minimum, hundreds of thousands for some of you that, never go out and spend any money, but still that's substantial. And if you ran a calculator, I did it the other day. I did $10 million at 5%. I think it was 5 or 6% over a 10-year period. And I think it was like $30 million, something like that. It was wild, right? 10 turns into 33 million. I don't remember the interest rate I used, but like that's compounding interest. The reason people don't keep their money is because, well, life hits. We have things we have to pay for. We have expenses we need to do. And when you pay for things, you stop earning on that. That is that opportunity cost lost. The wealthy don't allow that to happen. They don't. Let's use one of the wealthiest men in history. And I'm sorry I'm going to go here, but I have to. Elon Musk. If you have read about Elon Musk, how he does it, it is fascinating. It's sort of infinite banking, but a little different. Elon Musk gets paid primarily in stock options, right? Stephen, you know this. You know Elon a lot. So he gets paid in stock options, okay? A lot of his compensation, even these big compensations, how does he get paid? Can anyone tell me? Stock options. So he takes these stock options, holds them at some brokerage. Then he goes to that same brokerage and says, hey, I got $20 billion in these options here. Can you give me a loan on 50% of them? He doesn't need 50%, but like they give him a loan on 50%. Or maybe they're like, wow, Mr. Elon, your credit's a little rough right now. We're going to give you 20%. And he's like, yeah, whatever. So they give him a line of credit on that whatever $1 billion that I just mentioned in stock options. And then that money he just got, let's just say he had 10 billion and they gave him $2 billion, okay, in a line of credit. Is that taxable to him? Zero tax. It's a loan. He took a loan, okay? Some brokerage or firm gave him an advance of the loan, used his stock options as collateral. And then what does Elon do? Goes and spends that money. Did his stock options stop earning? If he does a good job at Tesla and the stock keeps going up, does he keep making more and more money? Yeah, it's uninterrupted. And then did he have the money to use throughout his life to buy all the things he wanted, invest in all the businesses he wanted? Of course he did. He didn't pay any tax either, did he? Nope. Doesn't that kind of sound like what we're talking about here? Now, I know, like, well, I don't know, but I think no one on here has $20 billion like Elon Musk, but aren't we doing the same thing? We're taking our money we earn. We're changing where it goes first, putting it in this stupid, specially designed whole life, built for high early cash value. Then what we're doing is we're finding places for that money to go. We give money away. We give money on car loans away. Okay. We give money. I mean, if you saw, we've done this, and I got to pause and transition here a little bit. We do a lot of modeling on cars, and it's been pretty consistent. Like the average car payment, if we were to average out, is like $800-900 a month. And when we do the math on these cars, even most of them are 5-year car loans or leases, but you look at the interest rate people are paying, it's usually like 6%. And you look at how much interest they're giving away. Have any of you looked at your car loan? Have you looked at your car loan? I don't care how low the interest rate is. Have you looked at how much the car actually is costing you? And if you ever thought about that, saying, you know what, I should be paying this same monthly payment to myself. Why am I paying this to GM instead of paying it to myself? And the only reason is, well, I didn't save up enough money to pay cash for the car. Well, of course you didn't, because that's not what we're trained to do. But you can start today, and you can start with small amounts, 200, 500, $1,000, whatever amount you want. It's just getting started. That's what you have to do. And that brings me to the next misconception. I'm kind of getting in that. I'm just running into it. It's, I can't afford it. We rarely hear this, but it used to be more common before all the education was out there about the infinite banking concepts. People saying, I can't afford this. If you ever say to us, I'm just going to warn all of you, if you ever get on the phone with us and you say you can't afford this, just brace yourself, because it's not about affordability. The next question would be, well, Mr., Miss, sir or ma'am, are you saving money today? Oh, yeah, we're saving $500 a month. Great. But you just said you can't afford this. Well, we can't afford this. You just told me you're saving $500, and you're talking about not being able to afford $500 a month going into this policy. Did you realize it's the same freaking thing? If you're saving $500, then you're saving $500. It's just going in a different place. This isn't an affordability issue. It just isn't. And if it is an affordability issue, it's because you're striving to put too much in. Back it down. It's just your savings. That's all this is. It is never and will never be about, can I afford this? And the reason I'll say that, I'm just going to write this on here. Here's the difference. It's so much in your mind. I can't afford this. Great. You're thinking about this as an expense. That is the only way you can't afford this, is a mindset where you're thinking about this as an expense. You see, none of us that are doing this think of this as an expense. This is a deposit. Do you want more expenses in your life or more deposits? Don't answer. You already know. Deposits. So if you just reframe the way you think about it, so how you're looking at it is, you're like, well, Chris, it is a premium. It's a premium payment. That's what you're thinking, right? And a deposit is, well, it's a savings. That's what you think of deposits, savings. But you know what? Here's what we do. We change our mindset. Yes, it is a premium. I cannot change the fact that this deposit into your policy is a premium, okay? But it is not a premium payment. It is a premium deposit. And I'm not just bending words here. That is truly what it is. You saw the numbers. You're putting money into this policy. A large percentage of that money is going to the savings component called cash value, where it is earning guaranteed interest plus dividends in a tax-free environment, protected from judgments and liens, and it provides a legacy for your family. Whew. Spit that out a bunch of times. Got it? Framing is all that is. It's not an expense. It's a deposit. That's it. And the last one, and we hear this a lot, but Craig and I, more Craig than me, one day just got sick of hearing it. We just all of a sudden decided, you know what? We've gotten to a point where we can pretty much mathematically prove everything. The Vault software allows us to mathematically solve every one of your problems, every one of them. So when we hear someone say, oh, well, why would you do that? Why don't you just buy term and invest the difference? Well, we've got the perfect answer. I don't even need to talk about this, but I'm going to let Craig talk about it a little bit. The simple answer is, we did a white paper where we dissected buy term, invest the difference, and we layered it right against we didn't even do a very good job with the design because we didn't want people saying, oh, you just made the best design. That's not going to work for everybody. So we did like just a mediocre 60-40 design, okay? And we ran that 60-40 design against every buy term invest the difference scenario, including putting money in a high yield savings, putting money in the S&P 500, all sorts of them. Craig, do you want to talk a little bit about that experiment and what came of that? Because it's now gotten industry acceptance to some level. Like industry experts have said, yes, this is the best, white paper on buy term invest the difference, and all of you can have it.
Yeah. So if it's something that you're interested in, you want, well, actually, I'll just put the link in the chat, then you can grab it. But to what Chris is talking about, the whole concept is, we've heard this over and over and over. Why would you put your money in this stupid whole life policy that doesn't have any cash value for the first 2 to 3 years, which we already talked about? That's traditionally designed whole life. And so what we did is we took this activity. It was about, I don't know, 6 or 7 months of just kind of working the models. But we've proven that long term, And here's the way we want to be thinking about our finances is we don't want to think about a particular sliver of time in our life. So for example, some people say, hey, I'm going to look at, my working years from age 30 to 65, and that's all they care about. What about legacy? What about when you're done with your money? What about retirement? What about the taxes? So we considered all of this stuff and we took the same amount of money, we bought some term insurance and we invested the rest of it into the S&P 500 using the exact S&P 500 numbers from some of the best 30-year runs that there were. So we tried to give the buy term invested difference the benefit of the doubt, giving the best market cycles that we could find. And then we went and bought a whole life policy and we ran different models where we did nothing with the policy other than fund it. So, for example, that's not what we teach, but if you just funded the policy, set it on the shelf, and let it grow, what would it look like when you got to retirement? And there was a period of time in this study where the buy term invested difference was ahead. But think about the turtle and the hare. The turtle and the hare, we know who wins. And in this case, the whole life policy won the race without even investing anything. Now, the one thing we didn't really look at in this model, Chris, remember how, so when we fund a whole life policy, what can we do with it throughout our lives? So we can buy cars, we can pay it back. We can use that money for other investments, we can pay it back. We didn't necessarily run that model because we just want to see what would it look like to fund the whole life policy and do buy term invest the difference. What would it look like at retirement? So we did that as a model. We also did a model where we took some of the money out of the whole life policy, put it into the exact same S&P 500 funds, ran the difference, and the whole life policy still won. Now, at the end of the game, when we have a legacy transfer, would you rather have a bunch of money in a market account that's going to be taxable and part of your estate, or would you rather have some of that money in tax-free death benefit transfer? So those are the other pieces. But anyway, for anybody that wants to see the document, the white paper, I'll put a link in the comments. But it was a fun project, and hope you guys get some fruit out of it because it's pretty eye-opening just for me to run through it myself, just do all the math on it.
Yeah, I've got a bunch of people I'm just seeing in the chat when Craig was talking, a bunch of people asking about PMC Wealth and meeting with the advisors over there. So I did put that chat in there a few times, or I did put it in the chat. So I'm going to put it in here again, just so if any of you want to get a hold of Stefan, here is the email address. You can get a hold of him about that. People are asking about 401ks, Roth IRAs, rollovers, and all sorts of stuff. That'd be the choice there. You can see right above buy term invest the difference. That's the link on that one. And Stephen, did you have anything to say? I know you love buy term invest the difference, but do you have anything you wanted to say about that? I'm gonna wait till you say it, and then I'm gonna finish up what I have to say about it.
No. I mean, you guys are just spot on. I mean, it's a lot of it's just misconceptions, things that have traditional things that people have always thought to be true that just aren't true. Like we always say with Will Rogers, and that's about it. I mean, once you really learn how this truly works and you learn how money really flows and how money really moves, it all starts to click, and you start to realize, hey, it's not about either or. Like I said before, it's about the and asset, and that's exactly what this provides.
Absolutely. And all I'll say about buy term invest the difference, listen, I own term insurance. I think most people should have term insurance. I have lots of IBC policies, but I still have term insurance because it was affordable and it's for a specific need. For example, one of our companies, it was in an infancy state. So the partners in that company wanted to make sure that if something happened to me, because I was the visionary, that there was money to be able to replace me with somebody, and that would be expensive. So we took a $5 million term policy out in that company. That was like a key man policy. But I also have a $1 million policy, 20-year term insurance policy that I took out years ago so that if I died, it would pay for our mortgage. That's what I did it for a specific use case, right? The mortgage payment. I didn't want my wife to have a mortgage payment. I wanted the house to be bought and paid for. So I used term insurance. And then I got all the death benefits with my policies, but I keep those different. So if you're going to use term insurance, understand this. You will more than likely, by statistics, outlive it. Let me repeat that. If you're doing buy term invest difference, you need to come to grips with one thing. When you die, you have about a 2% or less chance that there will be a death benefit paid to your family. You understand that? Because less than 2% of all term policies are paid out on. And it's not because it's a scam or anything else. It's just because you outlive it, because the actuaries are way smarter than you and they know the numbers. They know that probability of them having to pay out on a term insurance policy is less than 2% because they know how long you're going to live. They know the mortality tables. You can't beat that. It is just mathematics. So that's great. You're going to put money in term policy, and just for pure protection, and then you're going to save the difference. Now, the place where you're saving the difference, can you earn uninterrupted compounding interest in that place? Because chances are people that put money in that side fund for buy term invest the difference, that side fund, they're going to use that money. They're going to dip into it. Something's going to come up. You're going to have an opportunity to do something with that money. It's not going to just stay in that account for 10, 20, 30 years like they show you on the illustrations. That just doesn't work that way. So when we came up with that white paper, it just shows you can earn on every penny you put into the policy. The cash value will continue to earn for the rest of your life as long as you keep the policy in force. It will never, ever stop earning uninterrupted compounding interest. Buy term invest the difference, absolutely, fundamentally, and proven cannot do that. So make that concession, that idea that is a massive misconception. So when you're looking at all of these different things, these are just misconceptions, but in there, we went a lot of different directions. You saw how to use this for real estate. But one of the things that I think is really important is, there's a lot of great questions coming in, and I know we didn't get all of them. We've got an event coming up here in January, and it's going to be just a phenomenal event. I'll have Stephen tell you about it. But every week, this day, Wednesday, we do Ask Me Anything Happy Hour, where we can answer more questions that maybe we can get out here. But Stephen, tell them a little bit about the event that we've got coming up in January. And then I want to hit Rico's question here, and there was a couple other ones I want to hit before we close out.
Yeah, no, I'm super stoked. I mean, the event, so it's gonna be a virtual event. So just like you're on this screen right now today with Zoom, it's gonna be set up very similarly. We'll have I don't know, about a dozen various experts that we've been working with and partnering with over the last several years that have already worked with hundreds, if not thousands, of our students and clients over that time period. And we're all coming together for 3 days at the end of January to try and really kick off 2026 really strong. So it's going to be the Friday, Saturday, Sunday, the end of January, January 30th, 31st, and February 1st. We're going to start, I believe, at 10 a.m. in the morning and go right through till 4 or 5 o'clock in the evening. And it's going to be talking about everything from mindset to advanced infinite banking strategies to really diving in and how to use the vault very specifically to solve your money problem, to help you achieve your goals. We're going to bring in experts in different areas around real estate investing, different industries, different opportunities like that nature. We'll get into some tax strategies and savings. Remember, when it comes to taxes, it's not, tax days here and we got to make sure we file. Taxes is one of those things you should be strategizing and planning throughout the year and being cognizant of throughout the year. So we want to kick things off the right way in January, but I'm really looking forward to it. Like I said, we're bringing in some of the best experts in the country. That's one of the reasons we do it virtually, because otherwise it's hard to get the caliber of people we'll have presenting to you in one location outside of being virtual. So it's going to be really cool. I'll get the link and I'll put it in the chat box if anybody wants to grab a ticket. I think it's like $50 or something like that, with a VIP option that's under $100 that gets you a physical workbook, I believe, and some other really cool stuff. So we'll get the link out there, but I would invite all of you to join us for that 3-day training and really set yourselves up for 2026. A lot of opportunity will be coming as the economy and the markets change.
Yeah, and then Rico, if I'm saying your name right, all of the policies that we do, we never talk about this, but every whole life policy, if I'm not mistaken, just about every permanent policy sold has living benefits. Okay, those living benefits are going to come in the name of typically chronic illness or terminal illness. So what these riders do, they're on every policy. You don't have to pay for them. There are paid versions of these riders, but the ones that come for free. What it does is if you have a critical illness and your doctor says that you're going to die, Okay, what that will do, you can basically submit, and the insurance company will allow you to access part of your death benefit while you're living. And the same thing with like a terminal illness kind of situation, or there's chronic and there's terminal. So one gives you access to less versus more. And the difference is one, you're going to die. The other one, you got to, you got some situations going on. You can't perform, I think it's two of
Two of the six.
thank you, two of the six ADLs, activities of daily living, like going to the bathroom yourself, dressing yourself, eating for yourself. Then if you can't do two of those five, then they will let you access part of your death benefit. So the question was, if from somebody that I would assume has this, if I have a policy, and I don't understand the language, so please clarify this, but I live in Japan now, can I still get those benefits? Yes. These policies are portable. It doesn't matter where you live, where you go. You can basically, the policy was started here in the States, then the policy is still in force. You can use it. I don't know how the logistics of it would work, but you could call the insurance carrier and they could give you all the logistics of, okay, here's how this would work. We'd have to send it to a US bank account, blah, blah, blah. That's probably the case. But in today's world, they might just send it right to you there in Japan. So hopefully that answers the question. I saw one other one up earlier, and I don't want to make a big deal of this, but I do want to shed some light on something. So there's a company called National Life, okay? National Life of Vermont is the actual name of the company. They're a mutually owned life insurance carrier up in Vermont. You would probably know National Life as being like a big player in the IUL space. We do use National Life sparingly, but we use it because they've got some unique features. It sounded like they had a term insurance policy, and somebody had mentioned that you can't convert it to a specially designed whole life with National Life, but that is not correct. National Life does have whole life. They barely advertise it. They barely talk about it. The people in their back office that do the illustrations barely know how to design the policies. We've been teaching them, but we've got a couple of people that understand how to do it. But they do have a pretty decent whole life policy. It's not as good as some of the other ones we do, but if you're stuck with National Life, like let's just say you got a term insurance policy with National Life and it's convertible, but you want to convert it into something. Well, convert it into a whole life, but get us involved in that because we could certainly help with that conversion. It's going to be really important that they design your whole life properly because they're mostly an IUL company, but they've got this like little secret stash of whole life in the back room that they're able to issue to you. So hopefully that helps for that one. Craig, did we have any other questions that came up?
No, I think the term convertibility was the one I was going to mention some more on, like you just did. But part of the value of having a term policy and having it being convertible is if you're no longer insurable with the company you started the term policy with, you can typically convert that. Now, there are some other companies that will consider converting another company's term policy to whole life, but there could be some underwriting requirements for that. And the way I would look at this is if you're still insurable, we can go anywhere we want. We can go to any of the companies that we work with to do infinite banking and start over with a brand new policy. So you wouldn't necessarily need to convert it. The conversion comes in handy when you're no longer insurable. That's one of the big benefits of having a convertible policy. As a matter of fact, sometimes we'll consume some of the available death benefit you have on your life with a convertible term policy because we don't know what's happening in the future. In 2 years, what if you, God forbid, come down with some sort of condition where you're no longer insurable? Well, now you've got this policy that you can convert some of that death benefit in the future. So very powerful strategies to think about, but I just wanted to throw out a couple updates on the term convertibility pieces.
And there was another Craig on here who was talking about a policy because earlier we said the policies we design always have more, like you're going to over time have more cash value than the premiums you paid. But Craig was saying that he's got a policy after 35 years, his cash value is still less than his contributions. I got it, Craig, and this is Craig Parsons. You put it in the chat, so I'll say your name. Please send me that illustration. To be honest with you, I've not seen them. I mean, maybe, I don't know. I don't even know what to tell you. Something doesn't seem right about that, but again, I'm not going to say what it is because I don't know what it is that you have. But if it is a true whole life policy from a mutually owned company, maybe what you got, Craig, is because 35 years ago, maybe you got involved with an insurance company that demutualized. That could be one of the reasons that could have affected the performance. I just don't know. If you want, Chris at themoneymultiplier.com, feel free to send it to me and we'll review that. And I know we're at time here, but I was kind of, one of the things I really was going to show is we talked about the misconceptions. I was really going to show you how the infinite banking concepts work, because it's that process. But I think Craig and Steven did a pretty decent job. But one of the things we always show is like how to identify uses for the infinite banking. And it's very simple. Start with debt, always. Somebody was mentioning, and I wanted to show this real quick. Somebody earlier in there was talking about, I can't remember the comment, but it was something about debt and how would this work, so on and so forth. And I just want to show you something here, because this is pretty easy to illustrate and to show. And I'll wrap with this. So, you all know we're talking about a specially designed whole life. And then the main goal is we're going to take a loan from that whole life. We're going to use that money. It's going to run through a bank. Okay, this is your segregated bank account. And then it's going to come over here. Now, when you do your debts, it's super important. And this is what the Vault software does a really good job. It's important to put these debts in order from lowest to highest, or there's a whole bunch of different methodologies, and the Vault software runs the math. But if I'm just doing this to keep it simple, lowest to highest. So let's just say you've got a store credit card with $1,000 owed on it. And that $1,000, you're paying $50 a month trying to chip it away, and they're dinging you 20%. You got another credit card that you owe $5,000. It's for them vacations. You're paying $200 a month on that. And that one's only 15% interest. You got a car loan, 25K on, you're paying $600 a month. And that one's only 3% because you got it back in the good old days. And then, you got a line of credit that's whatever, we'll call it $5,000, $100, 8% interest. So you got all these debts. What you're going to do is you're going to save money over here. Now let's just keep this simple. We'll say $1,000 a month. You're putting $1,000 a month. Now, clearly, $1,000 a month doesn't seem like it. Let's actually lower it. I want to show this because this is for that one person. Let's use their numbers. Let's say you got $500 a month. That's all that you can save. $500 a month. That's it. So you put $500 a month into this whole life. Now, this is how I did it, folks, so I can speak with absolute conviction on how this works. What I did is I did a policy. My first policy was $1,000 with IBC. My first IBC policy was $1,000, but this one's $500 a month. Do I wait to save up? So this person had $5,000 in their policy, and a lot of people make this mistake. They're saving up in the policy, but they're waiting until they have enough to pay off the debts, right? They're like, I got to have enough to pay off whatever, all these debts or something. Never, ever, ever do that. What you do is set it up, and I did it quarterly. Set it up so that every single quarter you're going to take a loan. Let's say that loan in the first quarter was only $1,000. That's all you had. You're saving $500 a month, and you only have $1,000 after one quarter. You take $1,000 out. Now, what we're going to do, and actually I'm going to raise this. I'm going to call this $2,000 for that low credit card. You got $1,000 you took out. What we're going to do is we're going to come over here, and we're going to pay this credit card down from $2,000 to $1,000. Okay, so that's what happened. So the $1,000 went here, so we only owe this credit card $1,000. But what happened is, because the way credit cards calculate interest, your monthly minimum payment probably went down. So it used to be $50, now it's $25 a month. Now I know this doesn't seem like a lot, but here's what you would do. You would take that $25 a month that got freed up from that first quarter, and you would basically take that money and you'd roll it back into the policy. This is called a loan repayment. We call it recycle. Okay, but you got to set this up. This is going to help reduce the loan, because remember, you took $1,000 loan at we'll call it 5.37%, One America's rate. Okay, you got $25 a month that you're going to send back to the policy every month. So now every month you're building up $25. Every month you're taking this $1,000 loan that you owed, you're reducing it by $25 a month. But the whole point is you got an extra $25 going into the policy every month, and that $25 didn't cost you anything more, and you didn't have to work harder because it came from money you were giving away. Now follow me. That was first quarter. Didn't seem like much happened. You saved $25, hardly worth your time. But next quarter comes around. Now the next quarter, you're still saving $500 a month. You got $25 a month coming in, not much. But the next quarter, you got $1,500. Okay, compounding interest is there. You got a little extra from the 25. So now we take that 1,500, we come over here, we pay this credit card off. We no longer owe the 25. So now the 25 we were saving that first quarter is now 50. Okay, so let's just do the math here. It's now 50, but we also have an additional $500. So we pay this credit card down to 4,500, which reduces our monthly payment not from 200 down to 175. So now we don't have 50, we now have $75. See how I'm doing this? So now $75 comes back over here to the policy. And we just keep doing this over and over. Every quarter you do this, you will have more money. Even though you didn't save anymore, you're still saving the $500. But every quarter, this amount you take as a loan will be more. Two reasons: compounding interest and velocity of money. Every time you're paying down debt, you're freeing up a little bit of cash flow, even if you're not paying the debt off in full. So hopefully that helps for that person. But this bottom part of the circle right here, this is vital. You have to recycle and recapture the money, because this money here, this money we're giving away that you're recapturing, is so important for paying off the rest of your debts. I went about 5 minutes over on that, but was that helpful for that person that was asking? Oh, somebody was asking about, Stephen, can you hit that Q&A? That's perfect for National Life. So can you issue foreigners without visas, IBC whole life policies, if they have U.S. bank accounts, go through lab work and sign the documents in the U.S.? Yes, we can. So even if you don't have a social security number, we can use an ITIN. You need an ITIN, okay? And we can do that with One America, and we can do that with National Life. So there's very few carriers that we can do it. But so all this did right here, folks, is just showed the flow of money. This, forget about the whole life. This is the process we keep talking about. Why is the whole life so important? Because you could replace it with a 401k, you could replace it with a bank account, but the whole life is the only one that's going to allow your money to earn while you do this. I love when people like Carrie say, that makes perfect sense, because it is. It's just logical, right? When you see this, you're just like, oh yeah, that actually makes total sense. There's nothing about it that doesn't make sense. And that's why, like, we can't sometimes understand what the misconceptions are all about, because it's just a lack of knowledge. And Will Rogers, I'll finish with this. Will Rogers said it best. He said the biggest problem in America is not what people don't know. He said the biggest problem in America is what people think they know that just ain't so. We just covered that. The 5 misconceptions. What people think they know that just ain't so. Well, with that being said, folks, we're going to hit some of the questions that came in so we get them all, but I appreciate all of your time. Again, this afternoon, 4:30 p.m. Eastern, we do Ask Me Anything happy hour. If you want to join us because you got some questions that didn't get answered, or you just want to kind of have fun with the entire team, then go to my YouTube channel, hit the subscribe button, and also, most importantly, there's a little bell. Smash the bell so you're notified when we go live at 4:30 p.m. With that being said, we'll see all of you the next time. If you don't make it the next couple weeks, have a Merry Christmas and a Happy New Year. See you next week, folks. Thank you.